Hi, my name is Jin Choi and I'm the founder of Money Geek. And welcome to this 13th episode of this short course on investments. And today we're going to talk about Registered Education Savings Plans, also known as RESPs. RESPs work very differently from how RRSPs and TFSAs work. While RRSPs and TFSAs save you on taxes that you would have paid on your investment gains, RESPs actually allow you to receive grants from the government to help pay for your child's education. So let me explain how this works in more detail. First of all, when you open an RESP account, you first have to specify a beneficiary. In other words, you have to specify which child gets to benefit from your RESP. When you contribute into an RESP, you don't immediately get any tax benefits. However, when you contribute into an RESP, the government will also put a little bit of money in as well. So if you contribute up to $2,500 a year, the government will contribute somewhere between 20 and 40% of that amount, depending on your income level. While you can contribute more than $2,500 in a given year, the government won't give you any grants above and beyond the first $2,500 that you contributed. There's also a lifetime limit of $50,000 that you can contribute into any one RESP account, so I suggest pacing your contributions. With the money inside an RESP account, you can use it to buy stocks, bonds, and other investments. And while the money is inside the RESP account, you can grow that money tax-free. So in this way, it works just like an RRSP or a TFSA account. And when the child grows up and goes to college or university, the child can start withdrawing the money. When the child withdraws the money, the child will pay taxes on the accumulated gains, but not on the original contributions. So for example, if you contributed $20,000 into an RESP account, and if you grew to $30,000 by receiving grants and through investment gains, then that means that your accumulated gains is $10,000 while your original contribution is $20,000. Then when the child withdraws money from the RESP account, then he or she will pay full taxes on the accumulated gains. But he or she won't have to pay any taxes on the portion of money drawn from the original contributions. Now, because the child will probably have a much lower tax rate than you at this point, you will save on taxes in addition to getting free money from the government. However, if you contribute money inside the RESP account, and if your child doesn't end up going to college or university, you will have to pay a penalty. While you can withdraw your own contributions from the RESP tax-free, the government will take back all the grants that it gave you, plus it will charge you 20% above your normal tax rate on your investment gains that you accumulated inside the RESP account. For example, let's say that you contributed $20,000 into an RESP account, and let's say that the government gave you $5,000 in grants. And let's also say that you grew $25,000 into $35,000. Now, if your child doesn't end up going to college or university, then you can withdraw your $20,000 tax-free. However, the government will take back the $5,000, and of the $10,000 that's left, the government will charge you 20% above your normal tax rate. So if your normal tax rate is 30%, the government will take back 50%, so half of it. So of the $10,000 that was left, you'll only take home $5,000. And because of this, you shouldn't open an RESP account unless your child really intends to go to college or university. Finally, as with RRSPs and TFSAs, you can open a RESP account either with a discount brokerage or with a bank. However, some banks only let you buy their own financial products inside their RESP accounts. So for this reason, I generally recommend going with a discount brokerage. And that's what I had to say about RESPs. So let's summarize what we've learned today. We learned that when you contribute into an RESP, the government will also put up a smaller portion into the account as well. And we learned that you can invest and grow your money inside an RESP tax-free. You have to name the child who gets the benefit from the RESP account when you open the account. And when the child grows up and goes to college or university, the child can withdraw the money. And when the child withdraws the money, the child doesn't pay any taxes on the amount that you contributed. However, the child pays his or her full tax rate on the amount that accumulated inside the RESP account above and beyond what you contributed. Lastly, if your child doesn't end up going to college or university, then you can take back your own money, but the government will take back all its grants, and you'll have to pay higher tax rates on your investment gains that you accumulated inside the RESP account. And that's all I had for today. And starting in the next episode, I'll talk about some practical considerations, such as whether you should pay down debt or invest. So thank you very much for watching, and I hope you have a great day.